Aloha folks, thank you so much for checking out this video. If you are new to the channel, my name is Mark, Mr. Dividend Investor. So my question to you is, do you want to get paid cash dividends every month? So if your answer is a yes, you definitely want to watch this video. I'm going to show you that all you need is just three great companies, great dividend companies to invest on to create this portfolio that will give you dividends every month. So hope you like this video. Please do me a favor and hit that like button. And if you haven't done so, subscribe, hit that notification bell. I want you to join my little community of Ohana of investors as we invest in great companies and build that portfolio. So also, please remember that this is not financial advice. This is just me sharing. With all that said, let's take a look at these three companies. First on the list is Johnson & Johnson. So one of my favorite companies to invest on. If you're not really familiar with Johnson & Johnson, it is a holding company that engages in research, development, manufacture, sale of healthcare products. So you probably use this a lot. You got Band-Aid, you got all these other consumer health products that you have pretty much in your home. They also do medical devices that hospitals and clinics use, as well as medications that for other health issues, as well as they're one of the companies that are doing the vaccine for our current pandemic situation. So why is Johnson & Johnson a great dividend stock right now? So this is a article in NASDAQ. So you can see one of the things that they like about Johnson & Johnson is that in the past 5 years period, Johnson & Johnson has increased its dividend 5 times on a year-over-year basis for an average annual increase of 6%. So you can see that Johnson & Johnson currently pays out ratio is 46%. This means it pays out 46% of its trailing 12 months EPS as dividends. So if you want to read a little bit more, you can kind of look at the NASDAQ article. Now, if we look at Simply Safe Dividend, based on their dividend safety score, they rate it as a 99, which is very safe. Now the dividend yield is 2.44. Market cap is about 457 billion. So if we look down to some of the key metrics, you can see payout ratio is about 45%. During recession, they have increased their dividends. If we look down to the dividend growth, so you can see that last 20 years, if you have invested in invested in Johnson & Johnson, you would have grown 10% per year, which is fast. Even look at this last 5 years, 6%. Again, from 2002 to 2020, you can see an upward trend based on the chart. Now, what I really love about this company, it has been growing 58 years consecutive increases. More importantly, uninterrupted for 58 years without a reduction. So pretty impressive, pretty solid company. You can see your payout schedule would be quarterly, March, June, September, and December. The annual payout is $4.24 per share. Take a look at the ex-dividend, August 23rd. At the time of this video, it has been passed. Payout ratio would be, payout date is September 7th. Now, if we look down to some of the valuations, you can see payout ratio is right here. Now you can see the sector PE ratio comparison. Johnson & Johnson is 17.6, compared to the healthcare 20.5. Financials, you can see free cash flow payout ratio. You can see it's below 48%. The preference is below 60%. So now if we look at Yahoo Finance, you can see if we look down to the earnings, you can see 4 beats over the past 4 quarters. Again, the financials are pretty solid. You can see Revenue is about 82 billion. The earnings is about 14 billion. Looking down to the recommended trends for the September, you can see it's a mixture of strong buy, holds, and even some sell in there. It is between a buy and a hold. You can see the price target is in the high of 189. Currently is about 173. Now looking at tip ranks, you can see the price target based on tip ranks is about 190. At the time of this video is 173, with the 12-month forecast rated as a high of 200, the average about 190, and the low of 183, with a recommended strong buy of 6 buys, 1 hold. Now if we look at simply Wall Street, you can see based on their share price versus fair value, you can see 16% undervalued. So pretty good. You're getting it a good, in my opinion, a good discount because their fair value is about 208. Now the next one on our list is Coca Cola, another staple, another solid company, a company that engages in manufacturing, marketing, sales of non-alcoholic beverages. You can see some of the brands here. They got from soft drinks to water. It's in 130 plus years and 200 plus countries, so 200 brands worldwide. So a staple, very popular company. This is one that I really have in my portfolio, that it is a must in my opinion. Now if we look at Yahoo Finance, you can see based on their earnings, you can see they have beat 4 straight quarters. Financials, you can see revenues about 33 billion, earnings is about 7 billion. Looking down to the trends, you can see 13 holds, 7 buys, and 4 strong buy, with the rating of between a buy and a hold. Now the average is 62, so currently it's about 56 again. You're getting it in a good discount in my opinion. Now if we go to simply safe dividend, based on their dividend safety score, they rated it as 80, which is safe. Dividend yield is 2.96, and the market cap is 245 billion. Looking down to the key metrics, you can see payout ratio is about 74%, with increased dividends during the recession. Now, if you look at the growth, last 20 years, 8%, which is fast. Last 5 years, however, is only 4%, which is slow. Again, I always like to look at the trend. You can see based on 2002 to 2020, you can see an upward trend of the annual dividends per share. Again, 58 years of consecutive increases, and more importantly, uninterrupted for 58 years without a reduction. Your payout schedule, you're going to be paid quarterly, which is April, July, October, and December, with the annual payout of $1.68. Now, if we go to tip ranks, their price target is in $62, with the 12-month forecast rated as a high of 65, the average of 62, and the low of 59. Their rating is moderate buy based on 16 ratings. You have 10 buys and 6 hold. Now, if we look down to CNN Business, to compare, you can see their high is about 67, medium is about 62, and the low is 55. And their analysis recommendations is about 12 buys, 4 outperforms, and 11 holds. Now, checking out Simply Wall Street, based on their evaluation, it is a 22% undervalued. You can see from the chart based on the share price and fair value. Last on the list, one of my favorites as well, Realty Income. You can see they're very proud of it. You can see right here, monthly dividend company. This is a REIT. It is a real estate company that engages in rentals of spaces. So one of the things that you can see is that their real estate portfolio is very diverse, and they have a bunch of well-known companies that rent their space. As you can see from the picture, you got Walgreens. You also got other well-known companies that rent their spaces. Yeah. Now, if we go to Simply Safe Dividend, based on their dividend safety score, they have a 70, which is safe. Dividend yield is 3.990 with a market cap of 28 billion. Going down a little bit more to the key metrics, you can see annual payout ratio is about 83 with increased dividends during the recession. If you look at the dividend growth, average for the last 20 years, 5%. Last 5 years was 4%, which is slow. You can see again from 2020 to 2002 to 2020, again an upward trend. They did kind of stagned here for a little bit, but you see it went up. So again, dividend growth for the past 26 years, uninterrupted for 26 years without a reduction. So for this one, you're going to get paid monthly with the annual payout of $2.83 per share. Now, looking at CNN Business, based on their forecast, they rated as a high of 86, the medium of 79, and the low of 70, with analysis recommendations of 9 buys, 2 outperforms, and 8 holds. Now, if we go to Yahoo Finance, based on their earnings, they've had misses for the past 4 quarters. So again, with the situation that we're in, I think that's why. But I think, in my opinion, this is a solid company. If you look at the revenue, you can see the revenue has been going up. The last 2020 market cap is 1.6 billion. Earnings about 395. Looking down to the trends, you can see 12 holds as of September with 3 strong buys and 2 underperform. Their recommended rating is between a buy and a hold. Again, the average is 77. Currently, it's at 72. Now, if we go to tip ranks, their price target is 77 with the high of 81, average of 77, and the low of 70 with the rating of strong buy. You got 6 buy and 2 holds. Now, if we look at simply Wall Street, you can see their share price versus fair price, 41% undervalued. So their fair value rated as a 123. All right, guys, that's it. So again, if you want to get paid these cash dividends, check out these 3 companies. Again, this is not financial advice. This is me sharing. Also, if you want to learn about other ways to get monthly dividends, check out my other videos. As always, please remember, stay cool, keep investing, and I'll catch you guys in the next video, right? Take care. Aloha.